Taxes can be confusing, perplexing, and feel like this overwhelming puzzle. But it's an important subject that we need to pay attention to because it has a huge impact on your retirement income. And in today's episode, I'm answering the 5 common retirement planning questions about taxes. And in addition, I go over an unfavorable common tax surprise that most married couples may see in retirement.
Welcome to the Your Life, Your Money podcast with Scott Searns, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, a show all about your life, your money, and how we can help reduce your taxes. I'm your host, Scott Searns, also president and financial advisor at Searns Financial Group. Last month, we talked all about tips on year-end planning, tax strategies, and retirement, maximizing your retirement accounts. That was episodes 74 and 76. And today we're going to continue a little bit along that theme. Today we're going to talk about the 5 common retirement planning questions that we get about taxes. We've gone through a lot of year-end planning meetings, again, helping people maximize those retirement accounts as well as implement year-end tax strategies, things that need to be taken and handled before the end of this year. And as we do that, and as I see questions come in, today I wanted to talk about these 5 common retirement planning questions about taxes. Plus, stick around. I've got a most common tax surprise that couples see. So when first meeting with couples, here's a common surprise that they're not aware of when it comes to their taxes. So we're going to talk about that today as well. And then at the end, I've got a listener question in regards to taxes on inherited accounts. Could be a time that you might inherit some money or inherit some accounts. It could be from your mother or your father or a friend, somebody that's listed you as a beneficiary. And common questions always revolve around when we inherit money, how will that be taxed? Will you have any tax liabilities from any sort of inheritance? So I've got a question that will tackle a few of the different items, and maybe we'll have a show later on talking just specifically about that, but I thought it'd be helpful to answer that listener question in today's episode. Now, if you've been finding our podcast of value and benefit, feel free to share it with others. Share it with a friend, share it with a family member, share it with one of your favorite Facebook groups. Our goal here is to help people to continue to build wealth, reduce their long-term tax picture, enjoy their life today, and be financially confident about their tomorrow. We would really appreciate you helping us spread our message. So feel free, hit forward, send it to a friend, and we appreciate you helping us spread the message and helping people feel financially confident about their tomorrow. All right. With that, let's dive into the 5 common retirement planning questions about taxes. Common question number 1. Are all of my retirement accounts taxed the same? And last month we talked about a lot of different strategies and where to put your money and different types of accounts. And sometimes it's good just to go back to the basics and make sure we understand where we're putting our money and how it's going to get taxed. Because like the question asked, are all of the accounts taxed the same? The answer is no. Different tax accounts are taxed differently. Different accounts are taxed differently. So let's break these down. Primarily, most people are dealing with 3 tax buckets. The first bucket is the taxable bucket. Now, some examples of what might sit in your taxable bucket could be a brokerage account. It could be your checking account, your savings account. It could be a CD. In the taxable bucket, the way that this money is taxed is you are taxed each and every year on interest, on dividends, and potentially on gains or losses that you have in these types of accounts. The next bucket, our tax deferred bucket. The examples that fit into this bucket are the IRA, 401k, 403b, 457, your SEP IRA. If you're an entrepreneur and you've got your own solo practice going, maybe you've got your solo 401k. All of those are great examples that sit into the tax-deferred bucket. Now, how does this second bucket get taxed? Well, when you put money into that bucket, you actually got a tax deduction for the year that you put money into the bucket. So if you're making $100,000, you put $20,000 into your 401k. That year that you put that $20,000 into your 401k, your $100,000 of income just went down to $80,000 of taxable income. So you got a tax deduction when you put the money into the bucket. Therefore, the IRS has not touched that bucket yet. You haven't paid your fair share to the IRS, and of course, as you know, they always want their fair share. So any withdrawals that come out of the tax-deferred bucket are going to be taxed at your ordinary income tax rate. So all the money that comes out, you're going to have to pay taxes on. And then our third bucket is our tax-free bucket. Some examples that sit into the tax-free bucket are the Roth IRA, Roth 401k, Roth 403b, Roth 457. I'm guessing you're catching on to the theme here. Anything that starts with Roth goes into that tax-free bucket. Back to our example, you make $100,000 and let's just say you put $20,000 into your Roth 401k. Well, the way that the Roth bucket is different, the way that the tax-free bucket is different, is that you actually pay the taxes on the money up front. So tax-deferred bucket, you got the tax deduction. In the tax-free bucket, $100,000 income, you put $20,000 into the Roth 401k, you're still going to pay taxes on that $100,000 of income. But the difference here is that the tax-free bucket, just like it sounds, it grows tax-free, and in the future, all of your withdrawals from this bucket are tax-free as well. So the $20,000 that you put in, plus any growth on all of that money, will all come out to you tax-free. It does not go towards your ordinary income when you're filing your taxes. It is tax-free. So hopefully this helps you understand that not all accounts are taxed the same. Take your account, use our examples here, depending on which bucket it falls into will be how it gets taxed. And this is why I keep, pounding the table on the reason that tax diversification is so important. We don't want all of your money in just one bucket. Tax diversification is really, really important. And here's just one example that I want to give you of the reason why tax diversification is important. Because I know that we've been trained in the past to save in our 401ks, save in your 401k, save in your 401k. And there could be potential tax issues in your future if all you did was save into one bucket, which is that tax-deferred bucket. Let me just give you a quick story here. A new client, so a person that we've recently met, and they've saved all of their money into their 401k bucket. They are a single, and they need to make a withdrawal. So this is before they met us. They were trained to put all of their money just into their 401k bucket. That's it. So they have not paid tax on any of that money yet. And as we're going through the planning process, they've become a client. And now, first year in, they need to make a withdrawal. A rather large withdrawal actually is a down payment on a big purchase. And just because of this withdrawal, and they have no other locations to go to get money, this will push the person from the 12% bracket into the 22% tax bracket. On top of that, because of the money that they need to take out for the down payment on this purchase, it's also pushing them into Medicare IRMA surcharges, meaning paying more for Parts B and Parts D of Medicare because they had no other locations to go to get that money. Whereas if they would have had money in the taxable bucket, if they would have had money in the tax-free bucket, the withdrawals for this down payment could have been structured differently to keep them in that 12% bracket and also under the limits so they weren't looking at Medicare IRMA surcharges. So hopefully that helps you understand, because I get it, right? When we're saving, sometimes our focus just becomes, hey, what can we do right now? Let's just put all of our money here. At least we're saving money. But I really hope that you'll take this as take it to the next steps. Make sure you're saving money in different buckets that allows you then flexibility in your future. Okay, so that was question number 1. Let's move on. Common question number 2, which is a question we get all the time. Will my taxes be lower in retirement? And as you already know, the answer is it depends. However, for a lot of people that have saved maybe $1 million, $2 million, $3 million or more, and heck, for some people that have saved $500,000 or more, there's a good chance that their taxes will be higher in retirement than where they are today. And you might be wondering why, because you're thinking, well, I'm not working anymore. I don't have my wage income coming in from my job. And the reason for this, the reason sometimes your taxes might be higher in the same or higher in retirement is dependent on how much you've saved into that middle bucket that we just talked about, that tax-deferred bucket. Those IRAs, 401ks, 403bs, 457s. As I had mentioned earlier, any of your dollars in those buckets have yet to be taxed by the IRS. And one thing I didn't talk about earlier is that is the bucket, it's the only bucket that the IRS forces you to take income from. Starting at age 72, you have to take those required minimum distributions. And so let me just give you an example here of why this can lead to your taxes being maybe the same or higher in retirement. For example, let's just say you have $1.5 million in an IRA or 401k account. At age 72, the required minimum distribution would be $54,744.53. Then think about it. You have to add on top of that any pension income that you have coming in, Social Security income that you have coming in, rental income that you have coming in. When you add up all of those sources, maybe you're the same as where you're at today, maybe you're lower than where you're at today, or maybe you will be higher than where you're at today. And one of the things that people think is that, well, those required minimum distributions, well, they'll just be the same throughout retirement. But if your account is invested, hopefully you're getting growth, and that account could potentially grow through your retirement. But let's just say it stayed the same. The required distribution, let's say your account value stayed the same. Your required distribution actually does not. Over time, the IRS and the government, they want to push you to take more out of that bucket because they want their fair share. So that same $1.5 million IRA 401k value at age 85, the distribution, the forced income that you have to take is $101,351.35. Think about that. Over 6 figures in income for saving up over $1 million. You'll have over 6 figures in income in your 80s, and it'll continue to grow as you go higher in your 80s and you go into your 90s. And that right there is how people can end up with higher taxable income in their future than where they are at pre-retirement. Because again, to that $100,000 number, add in your Social Security, add in your pension, add in all of your other sources. So if you were just making a good income before, but you were a huge saver, and all you did was save into those IRAs and 401ks, you could potentially be putting yourself at more taxable income in the future. So while you thought, while you were saving, you were putting it away, you're getting that nice tax deduction, you were actually potentially putting taxes off to a time frame where they would be higher and actually cost you more. So that goes back to what we were talking about over last month, the reason to do a tax projection. Tax planning and tax projecting is so important to make sure that you're diversifying and putting your money into the right buckets up front rather than potentially costing yourself more in taxes in the future. Now, common question number 2 then, just to wrap up, will my taxes be lower in retirement? It depends. It depends on which buckets you've saved your money into, what your future income streams will be compared to where they're at today, and it depends on how much you've got in that IRA 401k bucket. And the main takeaway here is how important tax planning is to your future, running those projections of what income streams you have coming in today, what income streams you have coming into the future, factoring in those required distributions, and then maybe making the adjustments of where you're saving your money into. Okay, common question number 2 typically comes with common question number 3. Common question number 3 is, am I going to have as many deductions in retirement as I did while I was working? And the answer to common question number 3 is most likely not. Now, there's different types of deductions that you might have been utilizing when you were working. Let's just talk about some deductions that you might have been getting through your work. For example, if you were making 401k, 403b, or 457 contributions, as we had mentioned earlier, for each dollar that you put in, it reduced your taxable income in the year that you put the money into the account. Now, if you're retired, you're no longer making contributions, so you're no longer getting those deductions. Same thing if you're self-employed, making contributions to your SEP IRA, your solo 401k. Or another thing to look at is if you're self-employed, you might be getting the QBI or qualified business income deduction as well. So a lot of the deductions that you're getting while you're working will go away in retirement. Another good example is if you're on a high deductible health plan and you've been making those HSA, those health savings account contributions, that's one where you've been getting that deduction no matter which tax bracket you were in. Didn't matter if it was an IRA, 401k. This is kind of the fourth bucket when it comes to taxes. We'll get into that one on another episode, but putting money into that health savings account was getting you a deduction as well. So all of those deductions that you were getting when you were working that we just discussed, they'll all be gone. You won't be getting those deductions anymore in retirement. Now, most likely, if you were making those contributions into your retirement accounts or into your HSA account, most likely then you weren't counting on that income to live your overall lifestyle. So I don't know if it would have a huge impact on your retirement plan, meaning how much money you'll need to live each and every year. However, you won't be receiving those deductions in retirement. Now, the standard versus itemized deductions. There's deductions such as charitable contributions or interest on that you're paying on your mortgage for your home loan. And this one really depends on where you fall as far as how charitable you are, how much you're giving, and how much interest. But I would say majority of people, when they changed the standard deduction and raised it, most people no longer qualified to be able to itemize their taxes. But wherever you're at on that spectrum, if you no longer qualified to itemize your taxes, that was because the IRS was actually giving you a bigger standard deduction than where you were at from an itemization standpoint. So all in all, right there, that one went in your favor. However, just in the future, all of those items or abilities, right now, Congress can always change the rules and the laws, but all those still exist. But one thing to think about, if let's say they get rid of the larger standard deductions, it goes back to the way things were prior. A lot of people have their mortgage paid off before retirement. It's just something that they say, hey, I don't want this mortgage. I don't want this debt. I don't want to worry about it. And so if you were counting or utilizing interest from your home loan in prior years, prior to when they changed the standard deduction, but you plan to have that paid off by retirement, just know that portion, that could potentially go away of something that you might be utilizing in the future to reduce your overall taxes. But overall, to wrap up here, common question number 3, am I going to have as many deductions in retirement as I did while working? Most likely not. And in retirement, it could come down to, I'll say, interest on your mortgage and charitable contributions, depending on how much in contributions you make. Moving forward, common question number 4, is there a way to get tax-free income in retirement? I'll say the answer is yes. However, if you've waited until the year before retirement, or if you've waited until retirement, most likely you've waited too long. Always remember this, at some point in time, the government, the IRS, is going to want to get their cut. So at some point in time, you are going to pay tax on any sort of ordinary income, wage dollars, that you have coming in. And if you've saved into that IRA, 401k, 403b bucket, is there still a way to get tax-free income in your retirement? Well, the answer is yes, but you still have to pay the tax to, I'll say, maybe get you tax-free income later in retirement. And that's where we've talked about it over and over. Those Roth conversions come into place, meaning taking money out of that tax-deferred bucket, paying tax today, and getting it into that Roth IRA bucket, which grows tax-free, and you can make the withdrawals tax-free. Again, this is one where you want to sit down with your tax preparer as well as your financial advisor to see if these Roth conversions make sense for you. Does it make sense to make these transfers? And one of the big mistakes that I see from people not working with financial advisors, so as I hear people kind of talking about what they're doing in their own accounts, is they make these massive Roth conversions just to get them all of their money into the tax-free bucket. But when they made these massive Roth conversions, they pushed themselves, because again, you pay tax today, so as they're shifting their money, they're putting themselves in tax brackets that most likely they would have never even seen in their retirement. So they're paying too much up front to get themselves into that tax-free bucket. And so this is why it's so critical to take a very strategic approach. When working with clients, right now we're going through all of our year-end meetings, and with each client it's different. Some were not doing Roth conversions, some are doing small Roth conversions, some are doing larger Roth conversions, but it's all very strategic to get them up to the top of a tax bracket, but not go over into a new tax bracket. Or it's strategic to get them up to a certain Medicare IRMA level, but not get them over into a new Medicare surcharge level. And so it's all very strategic, dependent on where you're at today, future income sources, future potential required minimum distributions, and then putting all of that together to make very strategic decisions on how much should be converted. But a big mistake I see, so I hope you're listening to me, don't just go out and do a willy-nilly massive Roth conversion. You could actually be giving more to the IRS. Is there a way to get tax-free income in retirement? Another thing for those that are not yet there is looking and utilizing those tax-free accounts up front. So, early on, instead of using the tax-deferred bucket, IRAs, 401ks, you're utilizing the tax-free bucket, Roth IRAs, Roth 401ks. However, again, it goes back to, do you feel that your taxable income will be higher or lower in your future? If you're in the 30% brackets right now because of your taxable income, it doesn't make a whole lot of sense to be utilizing the Roth accounts, the Roth 401k, the Roth IRAs, the Roth 403bs. So there is a lot based on where you sit from a taxable income standpoint. This one, I would say, can you get there? Sure, there's always a way to get there, but does it make the most sense? Maybe not. You might actually be paying more in taxes up front than you otherwise would have if you would have just diversified your accounts and taken withdrawals over your lifetime. Common question number 5, and I like this one. It doesn't actually deal with accounts. It does. It deals with the withdrawals from your accounts, but it's more a personal question. Should I move to an income tax-free state in retirement? And that's a really good question. I find that I don't know if I would let taxes necessarily drive where I want to live. And I think there's many factors that go into here that you really need to think about. So having an income tax-free state could be very beneficial. And there are states that do not tax your income coming from your retirement accounts. There are states that don't tax certain pensions. And so that can be really, really helpful. But then you have to look at the trade-offs. So if you're, thinking about moving to a state where you're like, oh, hey, they look beneficial, they're not going to tax my income that I have coming from my retirement accounts, make sure you're actually looking at the overall picture. What about the property taxes? Would your property taxes be the same? Would they be more? Would they be less? What about the cost of living in that area? Each area here in the U.S. has, I would say, a different cost of living. So where you're going to maintain your same standard of living, would your costs potentially go up, stay the same, or would they go down? And then the most important factor is, hey, pick a spot to live that you're going to enjoy. This is your life. Don't let do they say let the tax tail wag the dog? Is that how that saying goes? Anyway, I think you're catching on is don't let taxes just control your life. Pick somewhere that you want to live because you enjoy it. Hey, if it comes with income that's tax-free by the state, that's great too. So I mentioned at the beginning of the episode a tax item that I find commonly surprises couples. And what that is that if one of the spouses were to pass away, most likely the remaining spouse is going to jump into a higher tax bracket. Let me explain. For example, a couple that's making $80,000 of taxable income would fall, right now at current rates, would fall in the 12% tax bracket. But a single making $80,000 of taxable income would fall into the 22% tax bracket. And you might be thinking, well, but wait a second, if one person passes away, one of the Social Securities go away, so, well, they'd have lower income coming in. Yes, but what if they want to maintain the same lifestyle? And the only location to go to get money is that IRA or 401k or 403b, meaning they actually now have to take more money out of that account. And remember, every dollar that comes out gets taxed. And so since they're taking more money out of that account to get up to the same standard of living that they had before, they're just replacing that other Social Security with withdrawals. Now they're at the same taxable income, and that taxable income is a higher rate. So leaving your spouse with an IRA or a 401k, essentially you're leaving more to the IRS in taxes. And this is something that if we think about it in advance, if we know about it in advance, we can plan for this and we can help reduce that tax burden while you're still a couple. So this is the most common surprise that I see when meeting with new people is that when looking at their tax projections, most likely if one person were to pass away, the remaining spouse could jump up into a new tax bracket. And I think it's really important that you think about that you plan for that, and do anything that you can to reduce that while you're a married couple. And last, as promised here, I've got a listener question, again about taxes. Our goal is to help you reduce your long-term tax burden. The listener question comes from Carol. Carol said, I received an inheritance from my mother who recently passed away. There was a brokerage account and an IRA account in which I was the sole beneficiary. Do I have to worry about any taxes on these accounts? Great question from Carol. I know Carol is not alone with these questions that she's asking, and let's just break this down specifically to the accounts that Carol's asking about today. So first, let's start with the brokerage account. That brokerage account, Carol, when your mother passed away, you got what's called a step up in cost basis. So let's just say the value of the account when your mother started it, and maybe it was 40 years ago. So the value of that account when your mother started it was $200,000. Let's say that grew over time to $500,000. Well, that's $300,000 in gains that if your mother was to sell the account, if she was to have sold it before she passed away, she would have paid tax on all of those gains. However, the current IRS rules, always subject to change, is you get what's called a step up in cost basis. So if the value of that brokerage account was $500,000 when your mother passed away, that is now your base value. Those $300,000 of gains, you do not owe tax on any of those gains. You now get the new base value of $500,000. Now, if your mother passed away, but then you waited a year to do something with this account, to actually take it into your name and make any changes, and if that account went from $500,000 and the value went to $550,000 and you decided to sell it all, well, now you owe taxes on that $50,000 of gains, again, from the date of time from when your mother passed away to when you decided to take action on that account. So when it comes to brokerage accounts, a lot of times it's in your best interest to go ahead right away, take that account under ownership, and if you need to make any sells or buys or whatever you want to do, it's usually in your best interest to go ahead and do those transactions right away, invest it how you wish for it to be invested, versus waiting and taking on any sort of tax burden. Okay, the second part of your question was that you're also inheriting an IRA account. Well, hopefully you're inheriting it properly, and the IRA account, once you inherit it, it will become what's called an inherited IRA or a beneficiary IRA. There's a specific way to make sure that you do that. Now, there's some IRS rules going on. It depends on when you inherited the IRA, if you need to take required distributions from it or not. And that's something that, I'm going to turn over to your financial advisor and tax preparer. But just to answer the general part of your question, since you inherited an IRA account, any withdrawals that come out of that account, you will have to pay income tax on. So any withdrawals that you take out will get added to your ordinary income and get taxed at your ordinary income rates. Carol, thanks so much for sending the question. I thought it fit right into today's episode. Hopefully you found those answers to be of benefit. Folks, I hope that you've really enjoyed today's episode. Now, if talking about this as we've gone through today, if taxes just feel confusing or they feel overwhelming, or if you're wondering how to reduce your taxes or how to keep more of your hard-earned retirement savings in your accounts versus giving it to the IRS, or if you're just wondering if you're putting your money into the right tax buckets and you want to take action but you're just not sure where to get started, we can help you with that. We have a process that can help you with that. And it all just starts with a 15-minute phone call. So if you're looking for help in these areas, if you're wondering, again, which account types you should be putting your money into, if you're wondering how to keep more of your hard-earned money with you versus giving it to the IRS, you can go to lifemoneyshow.com and click on the Work With Me tab. Again, that's lifemoneyshow.com. Click on the Work With Me tab, and you can set up a 15-minute introductory phone call where I'm just going to ask, how can we help? And if our services align with your needs, we'll talk about the next steps in the process. If based on our conversation, we're not the right fit for you, but we can help you out in that phone call or point you in the right direction, I'm going to let you know that as well. Again, that's lifemoneyshow.com. Click on the Work With Me tab. All it is, just a 15-minute phone call where we can get to know you and what questions are on your mind. I hope that you found today's show to be of value and benefit. If so, don't forget, subscribe on your favorite podcast player, and I look forward to our next conversation to helping you enjoy life today and being financially confident about your tomorrow.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and Searns Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Searns Financial Management, Inc. Searns Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Searns Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risk involved with purchasing bonds.